Okay, it's time to move forward now in our journey of loving our money better. This is our new episode of Money Love. Now, before we go further, I want to thank you for all your support, all the messages that you sent in. We really appreciate it. Remember, on the previous episodes, we talked about how you can start investing, how you can save, and how you can control your money better. This show is in partnership with Frio, which is a brand new digital banking experience aimed at helping you get more out of your money. So, Frio is our partner on this project because they want the same thing. They want you to be able to manage your money better so you can get more out of your money. Now, before we get into our episode, where this week we're going to talk about the different kinds of investments that are available and how you can choose which investment you have to use at this point. Before we get there, we have a question that's come in from one of our viewers. 01 Ashna has written in. She said, I have a quick question. How do you look for a financial advisor? What parameters should one take into account when appointing one? And that's an excellent question, but the answer is a little subjective. So this is the way I see it. I would appoint my financial advisor like picking a family doctor. Right? So when you imagine if you had moved to a new city or a neighborhood and you had to now get a new family doctor, what would you look for? You'd look for someone who had a decent number of years of experience, right? You'd look for someone who has a certain number of patients already coming in. So a client book, a decent client book. And for me personally, I prefer doctors who are patient with the patient and who basically take time to explain what the problem is, what the solution is, what medication they're giving, and why they're giving that medication. So to help you feel like you understand what is going on. I personally don't like it when they just write down medication, take it without explaining what is going on. So I use the same yardstick when choosing a financial advisor. I like someone who has a certain number of years of experience, someone who has a decent client book already, which means they already have built certain relationships with clients who use their advice. And most importantly, someone who doesn't mind sitting and taking the time to explain the situation, the advice, the solution they're offering you, and actually break down the investment they're offering you as well. Not someone who's just constantly trying to push a product and get commission and sort of get you to buy something as quickly as possible, but respects your process of understanding what is going on. So that is how I would choose a financial advisor. Someone with experience, someone with a decent client book, and someone who takes time and trouble to explain to you what is going on. You don't have to be a doctor to be able to know you have a good doctor, right? It's the same thing with a financial advisor. All right, so let's get to work this week. We had talked about how to find money in your income and start your savings. We had talked about how to get better control over your money. Now it's time to start investing. Now that you've saved some money, it's time to start investing. And a lot of times when people say, where should I invest my money? They say, should I do stock market? Should I do mutual funds? Should I do fixed deposit? And just the nature of that question suggests that the person asking the question doesn't know how each of these investments work. So I'm going to break this down really quickly and show you how each of these investments work, and then you will be able to make that decision for yourself, right? So before you go any further, before you start investing any money, you have to ask yourself two questions. First of all, what is this money for? Is it to buy a house, which is a big investment, or is it to take a holiday at the end of the year, or is it maybe money for my retirement for when I get older? So if you get a vague, sort of idea in your head on what this money is for, it will also give you a timeline. So if it's, say, for example, to buy the next iPhone, you know when it's coming out and when you want to buy it and how much money roughly it's going to cost. If it is to travel or to take a holiday, you know it's going to be in a year's time or so. If it's to buy a house or for your retirement, you have a longer sort of period to put that money together. And so you have a timeline and a target of what you're working with. It makes it easier to choose the investment. So we put a pin in that. We've got now our timeline of how much time we have on this money. And now we look at the type of investment. So fundamentally, all investments can mostly be put into three main baskets and one additional basket. Okay, so let me tell you what this is. The first one is debt investments. The second one is equity investments. The third one is commodities. So these are the three main baskets, and the additional basket is real estate. Now, real estate, we all know how that works. It's buying a house or buying an office, for example, and putting it out on rent and getting a return. That's a complicated sort of investment, and we'll get to that in a bit. But I want to first deal with the three main baskets, because this will help us understand almost all the investments in the market, right? So if we look first at debt investments. Debt investments are your fixed deposits, your bank bonds, your corporate bonds, PPF, PF, post office deposits. All of these things are debt investment. But what does that mean? A debt investment is when you lend money to somebody else. So someone's come up to you and said, dude, can you give me some money? I will give you interest on this. So it has certain things in common. One, you parting with your money for a fixed amount of time. And you get a fixed interest or a return on that investment. It doesn't change. So these are also called, for example, fixed income investments, because the return is fixed. So for example, the simplest type of debt investment is a fixed deposit, where you say, okay, I'm going to buy a 5-year fixed deposit for 1 lakh rupees at 7% interest. That means you are lending the bank 1 lakh rupees for 5 years, and the bank is going to pay you interest of 7% on that money every year. If you were to lend that money to the government of India, that would be called a government bond. If you were to lend that money to a company or a corporate, it would be called a corporate bond. Now, there are other investments that were started by the government called the post office savings schemes. These are also called small savings schemes, because they were meant to encourage people who have a little bit of money in hand to invest that money. So the Sukanya Samriddhi scheme, for example, the PPF, the Senior Citizen Savings Scheme. So there are lots of these savings schemes that are all fundamentally fixed income investments. They all have one thing in common. You lend your money to someone, they pay you interest on that money for a fixed period of time. So all of these investments will pay you a guaranteed amount of money, and there is very low risk, because you know your money is going to come back at the end of that term. The thing to remember though in fixed income investments is that there is a little bit of risk. So the return actually moves alongside the risk in all investments. The lowest risk is with government bonds, because the odds of the government not paying you back or defaulting on a bond is almost zero. So the government has the lowest rate. Then come the banks, then come corporate bonds, because the odds of a company not being able to pay you back are slightly higher, which is why corporate bonds come with a rating that indicates how likely they are to default or pay back. So that helps investors make those decisions. Fundamentally, you have to remember, if you're picking a fixed income investment, that the risk is low, but the return is also not great. And once you pay tax on the money that you have earned as interest, there's not too much left behind. So actually, these investments are great for a short term, for about 0 to 3 years, because then you're not worried about losing that money. And we'll come back to how that works. Now, the second basket that we must deal with is equity. Now, equity is super interesting, right? Because unlike just borrowing money from someone and paying them interest like we did in debt investment, in equity, the owner of a company actually parts with shares of that company. So if you invest in equity, you actually become part owner of a company, which means if it does well, you do well. If it does badly, you lose out, right? Now, the bigger ones list on the stock market, and that's how you can get access to them. So that's the way to invest in equity in India, is via the stock market. There are, of course, those companies that are not listed, and there are people who are angel investors and who invest in unlisted companies, but we won't get into that because that's a little complicated right now. We'll focus on the stock market. So the stock market allows you to own shares or portions of companies, and if you choose your companies well over a period of time, you'll see that the stock market has always moved upwards. So it does then, by research, tell us that the longer you stay invested in equity, the better your returns are, which means that if you have a longer period to invest, equity is a better bet. Remember, we talked about 0 to 3 years, debt is a better bet. A longer period, equity is a better bet. Now let's talk about commodities. Commodities is basically buying a commodity, something that's affected by supply and demand. There are many commodities available in the market. There's gold, there's silver, there's oil, there's agricultural goods, and the value tends to change based on the demand across the world. And there are people who trade in these values on a regular basis. But normally, investors like you and me who have day jobs and who actually have other stuff going on in our lives, we don't have the ability to sit around and monitor the commodity prices that much. So a lot of times that's not something that retail investors like you and I would get into. So this is where we are, right? So remember how we decided what we're going to invest our money in and how long we're going to invest our money for. Now you can actually put it into short term, which is 0 to 3 years, medium term, which is 3 to 5 years, and long term, which is anything above 5 years. Now, based on this, you can, in the first set of 0 to 3 years, invest purely in fixed income. In the middle, which is 3 to 5, you do a mix of fixed income and equity. And everything that's above 5 years, you can safely invest in equity. Now, a lot of people will say, but I don't know anything about the stock market. How do I invest in the stock market? Because how am I going to sit all day and track the stock market? Now, this is why mutual funds exist. Mutual funds basically means you give your money to a company that buys the stocks or the government bonds, depending on your instruction, or the commodities, depending on your instruction, and holds it for you instead of you having to spend time actually researching these things. And we'll do a separate episode entirely on how mutual funds function. What you must also remember here is that when you're buying assets, and this is important because a lot of times the goals that we're aiming for are assets, and as young people, you'll be buying your first asset, which is your first car or your first home, your first iPhone, for example. All of these are assets. There are depreciating assets and appreciating assets, the ones that go up in value. So if you're going to take loans, really remember that you take the loans for appreciating assets and not for depreciating assets. So once you've made your decision on where you want to invest your money, right, you can actually decide which asset class you want to be in. So which basket do you want to be in? Do you want to be in debt? Do you want to be in equity? You want to be in a mix of the two? Do you want to add some gold or commodities to it? And you do this with the advice of your personal finance advisor. And we will, in the next few episodes when it comes up, we'll talk about how mutual funds work and how you can get started on the stock market as well. Remember, this is a show in partnership with Frio, which is a brand new digital banking experience with the aim to help you get better control of your money and to help you make more out of your money. Thank you for watching. Leave us your questions and we'll come back next week with more answers and a deeper breakup into each of these investments.